everyone so much for being here today. We are going to talk to some really incredible investors who are invested in this region, and it's going to be kind of fun because it's a little bit different. If you were here last year, they got a chance to play a game. We're going to play a game right off the bat, but first I want them to introduce themselves. I got a long-ass bio. They don't want to hear it. They just want to get into the numbers. They want to know what check size you're writing, and they want to get into how you do it. So I would love each of you, if you can introduce yourselves, give us a little bit of your background, and then let's get into it. Brett, can you start?
All right. Hey, I'm Brett Brolt. I was an entrepreneur for a long time. Angel invested for about a year, then became full-time venture capitalist. I've been running a fund called Bread and Butter Ventures alongside my partner, Mary Grove, for the last 8 years. We invest in food tech, digital health, enterprise SaaS.
That was so fast, so good.
10 seconds.
Yes.
Woo. Okay. Sarah Russick. I have been on both sides of the funding equation many times as both an entrepreneur, angel investor, and venture capital. We have a Go for Angel network, which we launched in 2012, the first formal, structured angel organization in Minneapolis, and still alive and growing. And we have, through Capita 3, raised and deployed our first fund, and we are investing out of our second fund, and that is for women in healthcare.
Thanks, Sarah. And Chris?
Hi, this is actually my first time in Minnesota, so thank you for having me here. Chris Deutsch, I am a first check Chicago-centric angel investor. Been investing for 26 years, over half my life now. Lofty Ventures is the platform that I've built to support the 160 plus founders at 94 companies. 80% are in Chicago, 75% are led by underrepresented founders. And yeah, excited to be here.
Thank you so much. Okay, so before we dive into a ton of questions where we'll go really deep, we have a game we're gonna play, and it's called By the Numbers. So each of you has whiteboards in front of you. So I'm gonna ask you a question, you're gonna write a number on it, and then we'll go a little bit deeper into your specific answers. So, rapid fire. On average, how many days does it take you to get to a yes in an investment? I'll tell you how many it took me to get a yes investment. Go ahead. Show the numbers. Let's see. 7. Whoa.
That's high.
That's high. Brett, what's yours say? 30. 45, Sarah? Tell me a little, let's start here. Chris, tell me why 7.
When you're investing at when you're investing at first check, it is all about the founders.
Yeah.
And so again, I'm an angel. I'm not, these guys are a little bit more fund-ish. I am getting to know the founders as quickly as I can. And that's frankly why I'm an angel investor. My superpower is meeting people and quickly getting a read. So I would hope I can do it faster than 7. But yeah, it's all about the founder and their ability to,
Yeah, that's amazing. I imagine that you get to a no just as fast, yes? So a fast no?
Faster.
Faster no. I love it. We love a fast no. We hate a long maybe. 1?
1 day.
1 day for a no for Brett. Fair enough. Sarah, can you talk about 45? Why?
Sure. So 45. So Go for Angels is a group of accredited angel investors. Everybody writes their own check. We invest together through a very, diligent process, collaborative and formal. Now, what we try to do is cover a lot of territory in that time, and we take it very seriously. So as we're going through, it inevitably takes at least 45 days typically to get through all the diligence and all of the collaboration that goes on. I will say we just closed a deal, I don't know if it was last Friday night, and it was sending emails out and saying, okay, deadline is today at 5. I need to your yes now. And they pitched Thursday night.
Yeah.
So it was less than 24 hours later, we closed on a couple $100,000. So it can be a 1 day. Yes.
Yeah.
Too.
But that's unusual for you. I like
Very
that.
unusual. Yeah.
I will say I love this. I love the spread of answers, and hopefully that gives, if you're a new angel, gives you kind of a picture of the different styles of investing, right? So if you're in with a group, it might take a little bit more group think. If you're an individual who has the ability to say yes or no right away, that can be much faster. Brett, I want to thank you for your fast no to us a long time ago, because it could have been much longer than that, right? We could have been talking for years, but I appreciated that.
Can I give one example?
Yes, please.
My fastest yes ever was 4 hours from first meeting to founder to signed docs and wired money.
Wow.
I will never be that fast again. It was just a question of how much I was going to put in my range versus if I was going to do it, because the round was already closed and I wanted to get in at the cap that they were at. I'm very glad I did. It'll probably be my highest RRR.
Urgency. I love to hear it. Okay, let's do another question. What is the average number of companies you screen to get to one yes? I love this. I'm assuming most of you are getting like pitched daily, a 250. Wow, Brett. Oh, yikes. Okay, and we've got 15, 60, and 250. Brett, you have to start because that's ridiculous.
I probably meet with about 10 founders every week. On average, 10 new founders every week. I met with 3 this morning. And I'll lead somewhere between 5 and 6 deals a year. And so it really is high level, and that's everything from going and mentoring at different accelerator programs, incubator programs. A lot of the deals that we see come through referrals from our network, from other co-investors that we've invested with. We also do open office hours every Friday, where anybody on the planet can sign up for and just come pitch us. And so we have a very wide variety of ways that deals find us. And a part of our job is to really quickly get to a no on most of them, right? And
That's
so it's
right.
how do we really quickly identify, like, this is a no, move on, so we can dig into the companies that are really interesting. From that 250, we probably, do serious work on, 25 of those to get to one,
Sure.
or 20 to get to one, where we'll have a second meeting with about 20 of those 250 to get to one. So, super high, big funnel. And it's really increased over the last 2 years as well. So with the macro trends in capital availability, the amount of deal flow that we've seen has increased significantly over the last couple of years.
Yeah, I want to talk more about that in a little bit. I'm going to make a note about it. Sarah, can you talk about 60?
Sure. It's a pure numbers game. I mean, we have a funnel, and these are 60 qualified. Every 2 months we go through a cycle, and we get about 60 qualified deals that match the criteria. And from those, we screen, and we get down to the final about 5 who pitch at Go for Angels every other month. And inevitably, we invest on average between 1 and 3 of every company who pitches. So those are kind of the numbers.
Yeah, Chris, 15 was it?
Yeah, this is a little bit of a hybrid. I probably should have qualified. I'm actually not looking for new investments right now. I decided.
Don't pitch him.
Yeah, well, I'm also looking for Chicago startups, so it's a little bit. The end of last year, I decided not to look for new companies and focus on the 160 plus founders that I'm working with now, and do some other strategic stuff with Lofty. So this is a little bit of a hybrid. I'm probably more like 25 normally, but I call it sounding buoys. So if you're in naval warfare, you have sounding buoys out in the ocean that are actively pinging. And I have incredibly good co-investors. And if you're looking for founders in Chicago, like, come and talk to me, because I know most of them, if not all of them. So before I even have a conversation with them, I have a decent idea if this is even remotely a fit. So I'm pretty. It's pretty filtered already by the time I'm talking with them.
Sure. Yeah, that's interesting. There's Brett, who talks to everyone, and then we've got kind of like an investor who's maybe got folks down the pipeline a little bit further before they even get to him. Next question. Let's ask, what is the average check size that you write? $1 million over there for Brett. 350,000 for Sarah.
30K-ish.
30K-ish. I like the ish. Yeah, I don't think that requires much more talking. Let's move. That's what you write your check on. What is the average round size that you see?
Investment size, right?
Investment size, yeah, total. Like, what's the round that you're looking at when you're investing $1 million, 1.5 to 3 million? So, Brett, are you leading these rounds?
We'll lead about half the deals that we look at, which is also plays into some of the diligence time, how long it takes for us to get to a yes. And so when we're leading, we'll take a little bit longer to get to a yes. When we're following, it can be a quicker timeline as well. But yeah, we are leading about half the deals that we see.
How do you decide if you want to lead the round versus? follow on?
A couple ways. One is like, is there somebody else at the table or not? And who are the other people at the table? Are we comfortable with them potentially leading, or do we feel better about our diligence, about our ability to lead, and most importantly, probably our ability to support the portfolio company after we invest? And so, a big part of whether we should lead or not is, do we have the expertise? Do we have the network? Do we have the connections post-investment where we can really help this company raise subsequent rounds of capital? Can we really help them with biz dev introductions? Can we help them with the potential issues and bumps and all the things that entrepreneurs run into during their journeys? Can we help them get through those things?
Yeah.
And so that's like a big part of when we decide to lead, or if it's something we're really interested in, but we're not maybe the experts, we don't have that, then we'd rather see somebody that has a bit better expertise than we do jump in and lead.
For sure. Sarah, tell me more. 1 million to 5 million. You all are changing your answers. This is supposed to be like you give it and that's it.
Yeah, I know. Well, it's 1 to 5 million, I think is what I have there. 1 million to 5. We're industry agnostic. We invest in what the investors want to see, and so it really depends on if it's a SaaS startup or if it's a medical device startup. I mean, we run the gamut.
Yeah.
And so it also depends on where we're investing. We do most of our investing at seed stage, but we do follow on in Series A and into Series B. And so it's a wide swath.
Sure. Chris?
Yeah, I'm literally first check. So about a quarter of the investments I've done are first check, and 75%-ish are in the first round. And those are typically somewhere in the 250 be kind of low, like 300 to $1 million.
Yeah.
So $500,000's about the middle.
Yeah. This might be a hard question to answer, but how much equity on average are you taking? Because I know it really depends on the size of the deal and your checks. 10%. Brett, is that something that you guys are pretty standard? You know what you want to come in at?
Yeah, we in our last two funds, so we're on our fourth fund right now. Our first two funds, we were writing smaller checks, and so we didn't have ownership targets out of that fund. With our last two funds, we've gotten bigger and written bigger checks. We do try to own 10%. We don't. It's not a requirement, but we do try to get to 10% ownership upfront, which also plays into the last question of what round sizes there are.
Yeah.
Because the round size often indicates what the valuation of that company is going to be at our stage, at all angel stage and everything. It's more driven by how much dilution the founder is going to take rather than what the company's actually worth. And so all those things kind of play into how we calculate it, where we want to get. But we do try to get to about 10% ownership with our first check.
Yeah, Chris, on the other side of the spectrum, you're at 1%.
Yeah, it's a target. Frankly, right now, I'm usually sub 1, but in the past 2 months, I've invested in a 1 cap and a 1.6 cap. Those are really, really rare.
Yeah.
But, I'm throwing in 10K checks mostly right now. I didn't mention this. I'm not looking for stuff now, but stuff is coming in.
Sure.
So my number, the 15 that I said I look at, that's also being brought down, because if I'm looking at 5 or 10 things right now, that's high for everyone that I invest in, because they're so filtered coming in. But yeah, some of these crazy ones are coming in.
Sarah, I want to come back to you after this next question, because I'm curious how this works in angel groups. How many boards are you all on? This is a good question for your board.
Are we writing it?
Write it down, please. 8 for Brett, many for Sarah. Sarah, share more. Why so many? Too many?
No. So that I'm speaking on behalf of Go for Angels, because one of the greatest values, and Brett already hit on this, is, as has every speaker today, the value is not only in the check, but the value is also in how can you help that company, that founder, grow through this very critical time of their company. There's a lot on the line, and we have so much smart access to business experience, industry experience, and in order to share that, being on a board really does matter, and it does help. And so we encourage our angels to either join boards, because there's oftentimes a great fit. They're looking for what we've got, or advise, and it is great.
Absolutely. Great. Chris, anything to add?
Yeah, I'm only on one. I've been on one other board actually. Mary Grove is now on the board that I left for a mutual company we have. I am mostly an advisor when that happens. In fact, the company that I was on the board of, I was an advisor and then became a board observer. But typically, if they need more of my help, I join as a board of advisors. So probably about 10 or 15% of the companies I've invested in, I've joined it that way. But all of the companies, regardless if I'm an advisor or what have you, our whole focus is trying to help them raise more capital, current round, future rounds, build relationships, make connections so other people can be board members, et cetera.
Yeah, our angels at the Coven have been beyond helpful in terms of our board, and we have 2 angels on our board that I don't think we would be where we are at without them. So Brett, tell me more about your 8.
I just want to say, like, from like a board perspective, like one thing I think for super early stage companies, if you do join boards or you're on early stage boards where it's like 2 founders or 10 people, it's really important to keep in mind, and it does get lost frequently, and I'm on boards with people who forget this. I think it's like our job is to serve the CEO and help the CEO versus have the CEO report to us. And it always frustrates me when the boards start to go the other direction, and some of the dysfunctional boards I'm on, that is the impression that people that are oftentimes like first-time board members take is like, hey, we're here to be your boss. But like that's not the role of a board member. And it's really important if you do join boards as you invest to keep that in mind. Like your job is to be there to support that entrepreneur. Your job is to remove roadblocks, to remove issues that they're having, not to create additional ones or create additional work for that founder or that startup. Yeah, we have a fiduciary. Our job is to help make sure that we have a fiduciary and we represent all our shareholders. But the best way to do that is to get rid of roadblocks, not to like make a CEO do more work. So just a little bit of a soapbox I have.
Yeah, don't stay on the soapbox, because honestly, I really think that's so important to think about. Is your board is not just for like even financial direction or to introduce you to your next round of people. It's like my board is the people that I call when I'm feeling really stressed out as a founder and go, have you been in this situation before? How do I navigate this leadership conversation? So it's not just about the money and getting to the next round, but really about building a really strong relationship with that CEO and with that founder to help them move through, help them be able to make those decisions down the road because they're better leaders for it. And so I really do think, I was driving home from Des Moines and called one of my board members and was like, I need a leadership question right now. And they knew exactly what to tell me in that moment. So thank you for bringing that up. Our last question in this fun game is, what is the average valuation on the investments you're considering? This is an interesting question right now because we are in a bananas valuation time right now. $10 million is the valuation. $8 million and $3.5 million. So super early stage, yes? Super early.
Well, I'll add, and maybe we'll talk about this too. At the very early stages, you do this a little bit after pre-seed, but you will also often have the very early checks at a lower cap. Not that I'm negotiating for that, but they're just trying to get momentum.
Yeah.
And so that's why, like the one that was a 1 cap, there was like 3 checks on that, and they almost immediately go to a 3 or 4 or 5 after that. But they're just trying to get some of the good investors early. So because about a quarter of the deals that I'm doing are so early, sometimes I get some of those, but I'm not asking for that.
Gotcha. Sarah, you had 8 plus?
Yeah, again, pick the industry, pick the stage that the company's at. But typically, hovering around 8 million. I'm just throwing that out there.
Brett, feel the same way? You had 10 million?
Yeah, I mean, 7 to 13 is kind of like our range that we invest in.
Wasn't you?
They scared Sarah.
The squirrel.
I like sports.
This is such a great panel.
Yeah. I mean, again, like the round size that we invest in, it is largely times valuations are driven by how much companies are raising.
Gotcha. Awesome. Well, okay, give them a hand for their amazing game. Fantastic.
Did somebody win? It's just a squirrel.
You all won a squirrel. Congratulations. If you can catch it, you can take it home. I want to go deeper into the valuation conversation because obviously last year and this year, there's so much happening in valuations and also nothing happening in valuations. So what has changed over the past 12 months, do you feel? Sarah, do you want to start?
Sure. A lot has changed. So pretty standard word out. Everybody seems to know, but 2020, 2021, 2022, crazy times for valuations. The market really was an anomaly, and for all of us sort of in this field and doing what we're doing, it was a very, very stressful, tense, crazy time. Last year, we started to see the market rebalance a little bit, and it feels a lot better now. But what we're seeing in the deals that we're doing is, I will preface this by saying we do most of our investments at seed and Series A. And so 90% of our deals will fall inside of that. At seed and pre-seed, it's traditionally very resilient, very stable. Those valuations really didn't change much at all through all the crazy that was going on. We saw the biggest changes happening with skyrocketing valuations at Series A and beyond. The issue with that then is you've got all these founders raising money at very high valuations. And guess what? All those valuations were inflated. A lot of our founders who raised at high valuations struggled to raise additional capital at those valuations. That equals a down round. And nobody wants to do that. Yeah. We're doing a deal right now where they're having to recapitalize the whole company and kind of start over. And so we're really level where we're at. We feel good now about where things are stabilizing, but it's been a pretty crazy ride.
Yeah, Brett, do you feel the same way?
I mean, I think across our portfolio, seed stage valuations have come down 20 to 30% from where they were at highs. And so like the deals we're seeing right now and closing at on average are, about 20, 30% cheaper than they were in 2021. So yeah, from a pure dollar standpoint, down significantly less. The only thing that I would add to what Sarah said is it's also like is very vertical dependent and can be very vertical dependent as well. Like fintech, some digital health, alternative protein spaces have just gotten destroyed recently, like absolutely destroyed, where it's almost impossible to raise capital in some of those spaces depending on what your company is and what your company is doing. So there are also some spaces that have been very resilient through it. So it is, and that's true for every cycle, is that there's some verticals that'll come and go. Even in high markets, there'll be some that get crushed and some go up. And so right now there are some that are quite down, and it tends to be pretty cyclical in those different verticals. But I would say the only thing I would add is that seed stage, I think from an entry point, has been about 20 to 30% cheaper than it has for like literally same stage companies or for seed stage companies. The other thing that we've seen is that to raise that next round of capital, companies have to have significantly better metrics than they have in the past. So like the benchmark or what companies have to get to raise a Series A, if you're a SaaS company, move from like, call it 100K in monthly recurring revenue to, probably about 200K in monthly recurring revenue right now. And so the metrics that companies have to unlock the next phase of capital has changed pretty significantly.
Yeah.
And that those goalposts moved we're like kind of moving slowly last year throughout the year. And that's why last year was such a year of bridge rounds where companies had to come in. They hit the metrics they thought they were going to need to raise the next round. They got there and the market had changed on them, so they needed to continue to build and close a bridge to get there.
Yeah, the goalposts often move.
Yes.
And as a founder, I think there's a little bit of ego involved as a founder when you're trying to set your valuation. Sarah and I talked about this on our pre-call. Was a founder is going to come in and be like, "Well, I've poured my blood, sweat, and tears into this thing. I think it is valued much higher than what you think, investor." But tell us a little bit about the art and the science of this. How do you thread the needle, Chris, of picking that valuation?
Well, just to be clear, I'm not setting valuations.
Sure.
There's about a quarter of the time I'm actually the first check, and there's more coaching that I'm doing for the founders for exactly what you're saying. Is if I'm writing a $10,000 or $100,000 check or anywhere in between, I'm not commanding. It's not my place to set a price. I want to just make sure they're able to close the round.
Yeah.
Because if I'm the first money in, they need to close that round, or my money is at risk. So I'm just trying to help them understand, if you set your price at a 6 million cap now, it's not market. There's going to be too much competition with the other startups that are raising right now. Even if you're doing a great job, it's just like that's the reality. So I'm more than anything just trying to coach and help them. And the lawyers that were on stage earlier today were really, I actually tweeted about this. There is an equilibrium point that founders and investors should come to. And it doesn't matter if it's a cap or it's a price round or what have you. You want to make sure that as a founder, you're not getting too far over your skis, because then your next round is going to be impossible. And for the founders who were raising in 2021 that were going for like crazy valuations, a lot of those founders don't exist now.
Yeah.
You know, like their companies are gone because
Totally.
they just got too, like nobody wants to do a down round. There's plenty of other companies you can invest in where you don't have to do a down round.
Absolutely.
So I think like just thinking in terms of like, let's be rational and make sure that both parties are coming together and are happy about that price.
Yeah, that coaching is really important. And that's what we were kind of talking about before with the board is like your job is to help the founder move through this process. Most of them, if they're not a, if they're a first time founder, they're not going to know how to thread that needle.
We're in it together.
Yeah, absolutely. Brett?
I think it's
sorry,
really.
Sarah.
Oh, go ahead.
I was just gonna add two things that we think we set terms a lot of the time we set terms, and we're always thinking about a couple things, and it's a lot of what Chris said. And you can just in general, every seed stage round, the founder's going to give up 20 to 25% on average. Maybe it goes down a little bit, maybe it gets up to 30%, right? But on average, a seed round and a Series A round is largely driven by how much dilution the company's going to take rather than any type of multiple. And so when we invest in seed stage, when we're making investment decisions, we're never saying what's the multiple on their current revenue? What's the multiple on their half our companies have no revenue when we invest. Half our companies, none of our companies are profitable. So we're not doing multiples on anything. And that would just be a waste of our time, to be frank, to even think about that stuff. And so I would encourage any angels that come in early to not even worry about that. The other thing that what we do think about though, is we think about, okay, next round, we think about what's the risk return of coming in early. So especially if we're looking at a pre-seed deal or a pre-revenue deal, we think about, okay, you're trying to raise this at a 10. In the current macro, you're going to need to get anywhere reasonably above that. You're going to need to get to 100K in MRR with this money. Are you going to get there, or am I going to have another chance at an entry point? And as long as we maintain a good relationship with that founder, treat him fair, and say no quickly, there's a good chance that we can maintain a relationship and potentially get in. And sure, maybe they'll get to an 11 or a 12. And so we think about what's the reward for coming early? So can we get in if say, and we've actually told founders listen, if you want, we'll come in, but it's gonna be at a 6. Because we think then there's room for us to grow into the next round, which might be at a 10 or 12. And that extra bump is worth it for us. And so we think about that far more than multiples or anything that you would do in later stage growth equity, private equity.
Oh, music to my ears. I can't stand the word EBITDA. Anyways.
Hopefully not forever.
Yeah, not forever. I mean, someday I would like to. Yes, exactly. But as an early stage founder, that's not something any of us are able to talk about.
Oh,
yeah,
man.
exactly.
Well, it's a nonprofit. So.
No, for profit, very for profit. Sarah, anything to add there?
Well, sure. Maybe we want to talk a little bit about the what it might be like for
Yeah, we can talk about gender
different
dynamics.
kinds of founders raising.
Absolutely. Yeah. I mean, one of the questions I have for you all is around kind of what do you see difference in how women are approaching their valuation versus men approaching their valuation, how white folks are approaching their valuation versus people of color. Are you seeing a dynamic difference in, I have my hunches, and I have been told. So what do you think?
How about
what about
guys,
the
I'll
men?
start
Can the
this
men
one.
answer that question?
No, I mean, first of all, I will echo everything these guys said. It's about the dilution. It's about this. We're coming in at the riskiest stage. What is going to happen from here on out? Can this company achieve what they're going to do? Can we help them do that? And then after 3 more rounds, what will our stake be worth?
Mm-hmm.
So it's a numbers game. It's not about I like you game. It's about does this make sense for me in my portfolio of numbers? Now to the question about the gender, and I like that we're going here on this because diversity matters and it's really important. And I know that you guys invest in women-led companies, and I think that's awesome, and diverse founders. But it's really interesting to note that women are still commanding such a small amount of venture capital. It hasn't changed. We've been dealing with this at Capita 3 for, 5 years. Find Kathy Toon in the, audience and talk to her a little bit. But what I like to say is to just remind people that a woman CEO is getting about 30% less on their Series C than a male CEO. And that puts us behind. That puts women behind from the get-go. And there's a trajectory that gets affected. There's a growth that gets affected. And it's really hard to ever catch up for that. So be fair. Look for that alignment. Women CEOs need to ask for more. They need to value themselves more. And then they need to find partners who do the same. What I will say, the good news is, and I love this, is that while we do have a hard time starting behind the 8 ball, women CEO or women founders on a founding team, they actually increase their valuation at 63% higher than an all-male founding team. So add women to your founding team, invest in women on your founding team, and you will earn the ROI.
Amen, Sarah. Thank you. Clap it up. Yes. Anyone else want to take that question? Any alternative answers?
I'll just say quick, there's not a lot of room to move at the stage that I'm investing in. So I have not done deep analysis on this, but I don't really see any major differences. As I said, 75% of the companies I've invested in have at least one non-straight white guy like myself. So it could be female, BIPOC, LGBT. And I'm also not looking for those underserved groups. I'm looking for the best founders in Chicago, and we happen to have a lot of really great founders that don't look like me. And so it's not a strategy that I have, but it's definitely something that I've now embraced after I realized. Probably 5 years ago is when I realized about 2/3 of my portfolio were led by underrepresented founders. And I think the recognition of that made it tick up a little bit. But if I have any bias, I'm a little bit more biased towards looking for underrepresented founders because, as you may be able to guess, a Chicago focus is not just thesis, but there's also economic development. There's like a bigger picture that I'm going for with this. So if we can help those founders that don't look like me, that may live in different neighborhoods than I live in, we can raise all boats in Chicago. So that is something I do care about and think about. But in terms of like the values, it's not really happening at this stage. If there were those patterns that are going to emerge, it's going to be after, like in the C or A.
Yeah, that's fair. I mean, I know a ton of women founders who undervalue their company from the beginning. So they'll come into the meeting undervaluing themselves, and so
that's where we need to step up.
That's where you need to.
We do that.
Yes.
I mean, I do.
Absolutely.
I'll just add one thing. I actually do think that you need one of the things that we try to do, and about half our portfolio is led by female founders, about 60% is led by a person of color. And so we also have like really good diversity stats across our portfolio. Also think it's super important. We have had to be intentional about it. We have had to be intentional about not because we have quotas, not because we don't do anything like that, but intentional about putting ourselves or setting ourselves up and putting ourselves in situations where those founders can find us or we can find those founders versus like just assuming that it's going to happen. And so going to conferences or events or doing things or like open office hours every Friday. We've invested in female founders that have come to our open office hours and pitched us. And so having the availability and the openness to find founders that are different than what you might look like is really important. But it has to be intentional, I think, versus
Absolutely.
like assuming that it's going to come to you.
Yeah, I love to hear that intentionality. I mean, on the same note, like, how can you tell in these early conversations you're having like 7 discussions, 7 days go by and, you know yes or no. How can you tell in these early conversations if there's alignment between yourself and that founder? Brett, go ahead.
I loved there was the marriage analogy earlier today, and I actually often say that I'm going to be on a cap table longer than the average marriage in the United States lasts. So the average marriage in the United States lasts about 7.5 years. I'm going to be on a cap table about 8 on average, right? And so it really is that. So one of the things that we really think very hard about is the culture of that company. And there's not one right startup culture. There are a couple wrong ones probably, but there's a lot of different right ways to build a business, from like a startup culture, the way you work, how you work, what you do, all the things that go into culture, but it has to align with you and it has to align with your firm. The vision of what they want to do with the company has to align from the get-go. And so the first meeting, I do a lot of 20-minute first meetings. I do a lot of 20-minute first meetings. I don't really care that much about the idea in those 20-minute first meetings. It's all about like getting a feel for the person, understanding that person. Is this person somebody that like we think we can work with, we think can build a huge company. And then we can dive into all the stuff after that. So that first 20 minutes is like all about talking about I asked them about their story. Like 10 minutes of that first 20-minute meeting is just, why the hell are you doing this? Like entrepreneurship is really hard. Like why are you crazy? And hearing that story, and I also always ask, like, how are you going to take over the world? Those are two questions I ask in every first meeting is like, why are you doing this? And how are you going to take over the world? And that takes up most of it. And it just gives you a feel for the founder. And so we think about other stuff after that, but man, it's all about team, as everybody has said. And that first meeting is so important to dig into that more so than the idea or the financials or the revenue. Revenue model is going to change. All this stuff's going to change over the next 5 years. So like the people aren't though.
Those are such good questions. Yeah. Sarah, I want to ask you, because I know you coach a lot of angels along the way. So how do you think about your portfolio? How many companies should make up it? How diverse should that portfolio look? Talk about how do you coach your angels on this?
Sure. First of all, go kick a lot of tires, listen to a lot of meetings, meet a lot of people, attend a lot of events, get out there before you make any investments. That's number one, because you really have a lot to learn. And the portfolio question is an interesting one because we have such a variety of angels and gopher angels. And when we first started, it was, we were writing these collective checks and we'll see how it goes. Now, 10 years later, we have a lot of angels who are definitely structuring a portfolio, which is amazing. They're taking it much more seriously and building it over time. And it does take about 5 years to build a portfolio, typically. And what we like to say to them, first of all, invest in what you love and what you like. If you don't like something, if you don't get it, if you don't like the person, just don't do it. There's always another deal that you can find. Like Chris said, there's always something else. And then look at the numbers and make sure that you have the ability to zero that at the end of the day. Because I don't even know what are the stats these days, where a lot of companies go to zero, and they go to zero, pretty quickly. So be comfortable with losing that. Yes, you may get one or two companies that are going to make your portfolio. That doesn't typically happen with angel investors. Angel investors are going to get more of a 2 to 3 to 4x return. And so that's generally kind of the dollars we like to put out there. And then finally, just try to invest alongside people you like. It is a marriage. Everybody invests together. We have a huge syndication network. And allow yourself to invest with people who are smart about what they're doing at different stages in different industries, who you can learn something from, because it can be a lot of fun. It's a team sport. It's definitely a team sport.
Absolutely. How do you think about your portfolio, Chris?
Grow it, support it. It's funny. I really don't think about myself as an investor.
Sure.
Who's seen Office Space? I love when thank you. Gosh, it's scary when nobody knows Office Space. It makes me feel really old. I love the scene when, I don't even know what the guy's name is, but he's being interviewed by the Bobs. Yeah. And he's going, I'm a people person, damn it. Why don't you people understand? My superpower is understanding people and getting a good, quick read on people. And so it's not really investing what I'm doing at the stage that I'm doing. It's identifying, is this a good person? Are they passionate about what they're doing? In fact, I'll quickly say I have 4 criteria. I didn't know this 4 years ago. I'm now trying to help people learn angel investing. So they say like the angel curious. So if you're angel curious, come and talk to me. I'm giving away content for free. The first thing that I look for is giver in the Adam Grant give and take sense. And if you don't know what that book is, it's the most, I'm going to tell Adam someday. I've never met him, but I have lots of mutual friends. I've sold more of your book than anybody else other than you.
Give him some commission.
Yeah, it's an important book, but I look for giver. That's by far number 1. 2, brilliant. It's not very complicated. 3, they have to be gritty, scrappy, able to do a lot with a little. And then the 4th is where I say the rubber hits the road. That is very specifically problem, founder, fit. Everything starts with the problem. The founder has to have lived the problem and has a deep hate for it, but totally agnostic to the solution. So it doesn't matter if they're going to kill it with a banjo from like Zombieland or a flamethrower or whatever. It doesn't matter. It just has to kill the problem. So if you see a founder, this is a little bit of advice. If you see a founder that drinks their own Kool-Aid and thinks that their solution is absolutely the right thing, they're not going to listen to the market. They're not going to listen to their customers, and they're going to fail. Because there's only one Steve Jobs. Unfortunately, he's not here anymore.
Yeah, coachable people for sure.
Yeah.
Brett, can you talk about your strategy for follow-on investments? Like what makes you want to keep going with a founder?
Yeah, in some context, we'll probably, for our follow-on perspective, we won't reinvest in about half of our portfolio. About 35% of our portfolio will do pro rata, maintain ownership, and about 15% will try and buy up in subsequent rounds. And so it's, really, if every one of our portfolios or new fund, we're going to invest in about 35, 36 companies. So we really do follow like that venture returns model where 4 or 5 of those are going to return the vast majority of the capital. And so we are trying to identify those early. And when they go to raise their Series A, put our next big check in and try and buy up in that one because we know we're going to take a tremendous amount of dilution throughout their fundraise, throughout their journeys along the way. And so our strategy is go big early, buy a lot of ownership as early as we can, and then put one more check in, and then they're kind of on their own from our capital standpoint perspective. About 70% of our capital. So if you think about like, I have $1 million to invest in angel investments over the next 5 years, we allocate about 70% of our capital to that first check is the way we think about it. And about 30% comes into follow-on capital. And so if you're like doing mental math of how much should I put in up front versus how much should I reserve for pro rata, that's our balance. And I think the trend used to be actually doing a little bit less upfront and more for follow-on capital. And what we've seen from like our LPs, people that invest in our funds, what we've heard from them, and just from talking to other fund managers, is people have moved more and more towards the ownership upfront model and defending a little bit less model. So moving more towards the 50, 60, 70% upfront versus having huge, smaller allocation and a lot more to put in. And I think for us, like a part of the reason is like we're good early stage investors. Like I'm not as good at analyzing a spreadsheet and doing the multiples and doing, I can do it, but that's not like how we differentiate ourselves. And that's what really comes into play in Series B, Series C, later rounds, where you're thinking a lot more about that versus what we're actually really good at. And so, we want to buy as much as we can up front, and then leave a little bit to defend as we can. But that's our strategy.
Absolutely. As we wrap up this panel, because this is like rapidly coming to an end here soon, I want to ask you a question that kind of requires you to, think back to when you first started angel investing, and if there's anything that you would change or a lesson that you learned in some of your earliest investments.
I mean, I'll go real quick. The big one for me was learning about like the team and culture and making sure that you're well aligned. Like early on, I was more inclined to go with what I thought was a great idea versus a great person. And the longer I've done this, I've got about 150 portfolio companies also that I manage across our funds and what I've done with Techstars. It has moved so much to the other side of like, these people have to be people that I want to work with and I feel like I can work with for the next 10 years of my life. And they have to have the idea or that big vision of something that they can build versus I'm not going to invest in the founder that is like an asshole that might have something to it. Just not worth it.
Yeah, absolutely. Sarah.
So I think for me it was loving everything I saw. It was like, oh my God, that's the coolest thing. I want that. That's great. And so kind of like getting over that initial, and this is where David, my husband and business partner, we're kind of good because there's a little bit of a balance where one of us gets really emotionally engaged and the other one is like, what about the money? And so we can balance that way. But I think it's mostly loving it and then stepping back and doing the work of, is this a good investment decision? Does this make sense? Am I aligned with the founder? Is the founder understand the funding pathway? Will I make some money at this? And if not, am I okay to lose it?
Absolutely. Thank you. Yeah, Chris, how about you?
This is advice that I try to give to angels now. I did my first check when I was 23, over half my life ago. And it was a friend. Most angels' first check is they're a friend of somebody who's looking for capital. Mm-hmm. And that's actually bad. And the reason is because that you want to help them. And the odds of you getting your money back are very low. And you don't understand the idea of portfolio theory. So what I try to teach people is if somebody says, oh, I'm going in a friend and family round of, I'm putting $50,000 in it, I go, awesome. So you're allocating $600,000 over the next 3 years to invest in startups. They go, what? I said, well, it's not going to create your portfolio. So take whatever amount you're willing to spend on angel investing over the next 2 to 3 years and divide that by 12. And so I say, like, how about $25,000? Do 12 $2,000 checks over the next 3 years. And don't try to guess which ones you should bet higher or lower on. Because in the first tranche, you're just starting to learn. And so that's like my best advice is don't try to pick the winners, but do even amounts of capital over your first dozen-ish. I'd like that to be larger, but I think 12 is a round number over like 3 years. Because then it gives you, look at least 10 companies before you invest in one. So you're going to look at 120 companies over 3 years. You'll have only spent $25,000. That is a very, very cheap price to learn this industry.
Fantastic. Well, I want to say thank you to all three of you. I feel like someday when I exit my company, I will come to all of you for your great advice.
We're trying to get founders to learn Angel before. So.
Well, fantastic. I'll learn it and then I'll have the cash. So give them all a hand. Thank you so much, Chris, Sarah, Brett.